Hi, welcome back to AWC Trading. Today's video I will share about very popular chart pattern on technical analysis, but always make people lose money all the time. Stay tuned. So this video will cover predicting future movement using chart pattern is totally awful. I'll give proof to support that misleading mindset. Better approach when seeing a chart pattern forming on your chart. From previous video, I have already shared this classification. In fact, it's totally ridiculous. This group of patterns have neutral possible directions. The next one they say has continuation pattern, meaning after the consolidation phase, will go to the same direction as the big trend has. The last one is a group of chart patterns that will make a reversal move after finished consolidation. To be honest, this mindset is miserable. I'll explain more. First of all, chart pattern is a consolidation phase. Keep in mind forever that both directions, whether it will go up or down, is still widely open. The textbook says that after a particular trend, if you see head and shoulder pattern, the price is likely to reverse after the neckline broken. And reality is, price resume the trend. Another triple bottom on side. After a downtrend, price will reverse according to textbook. And the reality is, price goes sideways and downtrend resume. This is a very nice double bottom with broken neckline. Traders will rush, jump in, taking reversal positions, and they are all lose money soon afterward. This is falling wedge that textbook says prepare for the continuation pattern, and after the broken of the upside curve and people start taking buy positions, they are also lose right away. This bearish pattern also often mislead people, since textbook says it's a continuation pattern and price making sideways after that, price goes nowhere. The message is straightforward. Trying to figure out what kind of chart pattern is forming in front of us is often misleading. In reality, you have no idea to know what kind of pattern that market is going to make. Like when you think it's making a bearish flag, it's simply not. When you think this one will be a double bottom, simply is not. When you think this is reverse head and shoulder, simply is not. We have to realize that chart pattern is an awesome storytelling when on history chart only, like all mentors' presentations. We have to realize that chart pattern is not a tool to predict future movement. But when you really still want to notice a chart pattern, here are some considerations you have to adopt. Understand the bigger context of current market environment. The breakout pattern doesn't guarantee the future movement. Even sideways is still possible. Beware of the first breakout moment. Have to be patient to see if it's fake or not. Or if you really want to test the market, use smaller position size. Understand the market environment is crucial. At least we have to know the running trend, to downside or upside, and know the key level area, where the price may go towards, and zone of war between buyer and seller potentially happen. The last one is know the fundamental sentiment of the assets may give us advantage in the long run. This is an example of importance of understanding the market environment. On daily chart, Euro USD, current trend is to the downside, while with spot price already reached a fresh isolated key support area, and we consider to take action here. We should analyze pro and cons taking buy or sell position. Here, if we sell, we are on the same side as the current trend, but at the moment, price has now reached the key support. Better wait for higher price to take any sell position. On the contrary, if we buy, although we are not that confident price will make a huge reversal at this point, at least we get the retracement. So at this support level, we're more likely to take a buy position rather than a sell. Down to 15-minute chart to observe more detailed situation. Price now make a kind of chart pattern that we don't care what the name it is, because it's not important. We already understand that we have to be prepared for both possibility. But if the price break low, we don't take any action. We only take action if the price breaks high. That's our preparation. Short of the story, we have two chances to entry buy position after the consolidation breakout or at the retest. Above profit target, since we predict it's only a retracement, we use Fibonacci retracement tool to help us identify some potential reversal area. 50% is the most important key level. This buy positions has made more than 70 pips floating profit. We could protect our position by moving stop loss slightly above the break-even, or move it little by little according to the remaining level of the Fibonacci. Whatever the scenario is, this position is already profitable. This is the example of importance to understand the context of the market. Breakout of the pattern doesn't guarantee anything. The more experience we have as trader, we have to be wise enough for any future scenario. We just cannot trade blindly based on textbook. Next, no action at the first movement. More if the scenario is just the opposite of the context we believe on the running market. Or perhaps you consider to take any action after the second breakout with smaller position size. It's up to your management risk. Recap. Don't memorize chart pattern because it's not important. Since you know the chart pattern is consolidation phase, always be ready for any direction move. Must understand the bigger context of the market environment is the key. Some technical indicator may give great help through the consolidation phase, like moving average. Check my previous video for more detail. That's it for today's video. If you like or learn something new, consider to hit the like button and subscribe to this channel, because more useful videos are about to come in the near future. See you next time.